In this class, we've been talking about how important it is to recognize revenues and expenses in the correct accounting period. Because of this emphasis on the correct recording of transactions, we need to be able to adjust accounts that are in our ledger to reflect the actual activities that are being performed during an accounting period. So we provide what we call adjusting journal entries to ensure that the revenue recognition and the expenses are being recognized in the correct periods. We do this every time that we prepare a financial statement to ensure that transactions are properly recorded. Adjusting entries are made for 4 different situations. In general, they are called deferrals and accruals. Deferrals can fall into 2 categories: adjusting prepaid expenses or adjusting unearned revenues. Remember, prepaid expenses are assets and unearned revenues are liabilities. Normally, the adjustment for a prepaid expense is in the situation where we have a prepaid expense and we've used a portion of that prepaid in the current period. An unearned revenue, a liability, is in the situation where we've now earned the revenue and we have to reduce the liability. On the accrual side, if we accrue a revenue, means that we've earned the revenue but we have not received the cash yet from the customer. So we therefore need to make an adjusting entry to recognize an increase to the revenue account and an increase to the asset accounts receivable. We also need to consider accrued expenses. Accrued expenses are expenses that have been incurred but we have not paid for them yet. So we would increase an expense account on the income statement and recognize the liability increase to accounts payable. So first of all, one of the things that we have to do when we want to create an adjusting journal entry is first take a look at the trial balance. When we look at the trial balance, we should see that certain accounts have balances in them that need to be adjusted or brought up to date because of the activities of the company during the period. We look at the entry to see if we have to adjust for a deferral of either a prepaid expense or an unearned revenue. When we use the term defer, we normally mean that we're putting something off. So a deferred expense is where we've paid for the cash payment, but we've deferred the recognition of the expense until it's been incurred. An example of a deferred expense is like insurance. If we pay for an insurance policy that's going to last for a year, we are planning to defer the recognition of the insurance expense until we actually use the insurance. If the insurance policy is for 12 months, we need to recognize the insurance being used each month. Therefore, we need to make an adjusting journal entry to reduce the prepaid insurance account as we progress through the year. So a prepaid expense is a cost that expires either with the passage of time or through use. We make a journal entry to recognize the use by increasing an expense account and reducing the asset. So here's what the T accounts might look like. We have 2 accounts, the asset account and the expense account. The asset would be a prepaid, such as prepaid insurance, and the expense account would be insurance expense. We would maintain a balance on the debit side of the prepaid insurance account, and as each month goes on, we would reduce the prepaid insurance account with a credit, and we would increase the expense account with a debit. So here's an actual example. Sierra Corporation purchased supplies costing $2,500 on October 5th. Sierra recorded the purchase by increasing or debiting the asset account. This account shows a balance of $2,500 in the October 31st trial balance. At the close of business on October 31st, the company goes and counts the inventory and finds out that there's $1,000 of inventory remaining. Since the trial balance amount of $2,500 is on the T account, we need to make an adjusting journal entry to reduce that account to $1,000. So, on October 31st, we need to make an adjusting journal entry to reduce the account by $1,500. When we use a prepaid up and need to make a credit adjustment into the prepaid account, such as supplies, we need to recognize an expense that we've used the resource. So we make a debit entry on October 31st of $1,500 in the supplies expense account. Let's look at another example. On October 4th, Sierra Corporation paid $600 for a one-year fire insurance policy. The coverage began on October 1st, and Sierra recorded the payment by increasing or debiting the prepaid insurance account. This account shows a balance of $600 in the October 31st trial balance. In other words, they have not adjusted the account after the purchase. Insurance of $50 expires each month, so we need to make a journal entry each month to reflect that we're using 1/12 of the prepaid insurance policy. We reduce the prepaid insurance by $50 by doing a credit, and we increase the insurance expense account by $50 by doing a debit. Another deferred expense that we need to make adjusting journal entries for is when we acquire long-term assets such as buildings, equipment, and motor vehicles. When we purchase these long-lived assets, we record the entry at cost, and we make sure that we allocate the cost over the useful life of the asset. At the end of each period, we need to compute how much of the asset we've used up that we can allocate the cost into the income statement. So here's an illustration. For Sierra Corporation, assume the depreciation on office equipment is $480 a year, or $40 a month. Each month, we would need to recognize the use of the equipment, $40, and increase the depreciation expense. We would credit the accumulated depreciation account for the $40. Note, we're not going to reduce the value of the equipment because we want to show what the equipment actually cost. We also created this account called accumulated depreciation, and we reflect the usage of the equipment in this account. The term accumulated depreciation is known as a contra asset account. When we present depreciation of a long-term asset such as equipment, we want to show the equipment at its cost and then net the amount of the accumulated depreciation to give us what we call net book value. In summary, prepaid expenses are deferred expenses. We pay for the benefit in advance and then we use it over a period of time. At the end of each accounting period, we need to take a look at these deferred expenses to determine how much of the asset we've used up, and we need to make an adjusting journal entry so that we do not overstate the asset or understate the expense. So, when we use up a prepaid expense, we will do an adjusting journal entry to debit the expense account and credit or reduce the asset. Another type of adjustment that we've been talking about have to do with unearned revenues or deferred revenues. Typically, unearned revenues occur when we've received cash in advance but we haven't earned the revenue yet. An example would be where we get a deposit from a customer. When we receive that deposit from that customer, we've received the cash but we haven't done the work yet. And since we haven't done the work yet, we haven't earned the revenue. So we need to recognize that we have unearned revenues, a liability that we are obligated to satisfy. So when we have unearned revenues, we need to create an adjusting journal entry to record the revenues as we earn the revenue. That adjusting journal entry will be a debit or a decrease to the liability account and an increase to the revenue account. So here we can show that we have a liability account with an unadjusted balance. As we do the work, we are going to reduce the liability account with a debit entry, and we're going to increase the revenue account with the credit entry. So here's an illustration. Sierra Corporation received $1,200 on October 2nd from R. Knox for guide services for a multi-day trip expected to be completed by December 31st. Unearned revenue shows a balance of $1,200 in October 31st trial balance. From an evaluation of the service Sierra performed for Knox during October, the company determines that it has earned $400 in October. So from the October 2nd transaction where they received $1,200 from R. Knox, they have a balance of $1,200, but during the month of October they actually did the work. They've earned $400, so they must reduce the liability account by $400 by performing a debit adjusting journal entry of $400. When we reduce the liability of $400 and we're going to increase the revenue account by $400 because we've earned the money. So in summary, for an unearned revenue account, which is a deferred revenue, we defer revenues until we earn the revenue. Before the adjustment, if we do not make this adjustment, we will be overstating our liabilities and understating our revenues. To correct that situation, we need to do a debit entry to the liability account to reduce the liability and a credit entry to the revenue account to increase the revenues. An example of a situation like this are retail stores who issue gift cards. When you go to a retail store such as Starbucks or Best Buy or any of the other major retailers, you go out and you purchase a gift card and provide cash in exchange for that gift card. The question is what does the company do with the cash, and what do they do when they issue the gift card to you, the consumer? The gift card is a liability to the retail store. They have not earned anything yet because they haven't sold a product. All they have done is receive the cash and in exchange a promise to sell a product to the customer in the future. So therefore, the cash received increases the cash account, but it also increases the liability account. Another type of adjustments are called accruals. We accrue revenues or accrue expenses. Accrued revenues means that we are recognizing revenues even though we have not received the cash yet. We recognize accrued expenses because many times we receive a product or receive the benefits of a service from somebody and we haven't paid for it yet, In fact, we may not have even received an invoice from them to expect payment. So, the accrual of revenues means that we've performed a service or provided a product and we've earned the revenue, but we have not received the cash. So we need to make an adjusting journal entry to recognize revenues, and we have to recognize that someone owes us money. So an accrued revenue adjustment shows that the receivable exists and that we've also earned the revenue. So from a T account standpoint, we would need to make an adjusting journal entry to increase the revenue account with a credit entry, and we'd have to increase the receivable in the asset account with a debit entry. So here's an example. In October, Sierra Corporation performed guide services for $200 that were not billed to clients before October 31st. Even though we have not billed our client yet, we have earned the $200 revenue. So, a customer owes the money and we've earned the revenue even though we have not requested payment yet from the customer. So we need to increase the accounts receivable account by $200 with a debit, and we have to increase the revenue account by $200 with a credit. This adjustment would properly reflect the recognition of the service performed and that the customer owes us the money. So in summary, accrued revenues recognizes revenues because we've earned the revenue even though we have not received the cash yet. Before the adjusting journal entry, the assets are understated and the revenues are understated, so we need to make an adjusting journal entry to increase the assets with a debit, and we have to increase the revenues with a credit. Another type of adjustment that needs to be made is to recognize accrued expenses. Accrued expenses tells us that we've recognized the expense before the cash has been paid. For instance, if someone provides a service to us, such as an employee who has not been paid their payroll yet, the company is still liable to the employee to make that payment. The company has had the benefit of the work by the employee, so they have to recognize a wage expense, but they also have to recognize that they owe the money to the employee in the form of wages payable. So, an accrued expense serves the two purposes of one, properly recording the obligation or liability, and two, recognizing the expense that has been incurred. So, from a T account perspective, we would want to make sure we increase the expense with a debit entry, and we have to increase the liability with a credit entry. So here's an example. Sierra Corporation signed a 3-month note payable in the amount of $5,000 on October 1st. The note requires Sierra to pay interest at an annual rate of 12%. So, the $5,000 we borrow, we need to pay interest at a rate of 12% per year. Now, we don't have to pay 12% in total each month. We need to pay 1/12 of the 12%. Notice in the blue box here the calculation of simple interest. We take the face value of the note, multiply it times the annual interest rate, and then multiply it times the amount of time that we're calculating for the year. Since we are calculating monthly interest, we can use the fraction 1/12. So we are looking at $50 of interest recognized each month on that note. So at the end of October 31st, we need to increase the interest expense account by $50, and we have to increase the liability account called interest payable by $50 with a credit. By doing this, we will be recognizing that we have received a benefit of $50 of interest for the month of October. Another example. Sierra Corporation pays salaries on October 26. The next payment of salaries won't occur until November 9th. Remember, we're doing this for October 31st, so the employees have been working October 26th through October 31st. The employees receive total salaries of $2,000 for a 5-day work week, or $400 per day. Thus, accrued salaries at October 31st are $1,200. We calculate that by taking the $400 per day times the 3 remaining days in that month. We need to recognize that we received the benefit of $1,200 of the employees working for us for those last 3 days, so we need to recognize the expense by doing a debit to wages and salaries for $1,200. Because the payroll is not going to occur until October 9th, we need to recognize that we owe the money to the employees by doing a credit to the salaries and wages payable account. So in summary, accrued expenses are expenses that we have incurred but we have not paid for yet. We may not have even received an invoice from our vendors to ask for payment, but we still owe the money. Before the adjustment is made, our expenses are understated and our liabilities are understated, so we need to make the adjustment to get those two classifications correct. We would do that adjustment by doing a debit to expenses and a credit to the liability account. Here is a summary of the 4 different types of adjustments we would make at the end of each period. Note in the second column that if we fail to make the adjusting journal entry, what would happen to the various accounts on the balance sheet and the income statement. In order to make those adjustments, in the third column are examples of what the entry would be to make that adjustment to correct the balances. Once all the journal entries have been made, we would want to post those journal entries into the ledger so that we have all the accounts updated in the general ledger. Once the general ledger has been updated, we would take the balances in each of those ledger accounts and create an adjusted trial balance. We've talked about the trial balance prior to adjustments as a tool to make sure that our debits equal our credits. The same situation occurs with the adjusted trial balance. The adjusted trial balance is taking the balances from our general ledger and posting them up in the debits and credits to ensure that our debits and credits remain equal. Here is an example of what the adjusted trial balance would look like for Sierra Corporation after we had made all the adjusting journal entries. Note the items in red are the accounts that have been changed because we have made adjusting journal entries. In real life, we would not have to change the color to show that these accounts have been changed. They're merely an illustration for you as you look at how accounts have been changed because of the end of the period adjusting journal entries. Note that the debits and credits are equal, so therefore we have been posting our transactions correctly. Once we've created adjusted trial balance, we can then create the income statement, retained earnings statement, and the balance sheet. We can do that by going back and looking at that adjusted trial balance and noting that the accounts are in an order that we could be able to determine the financial statement. Notice cash is on top all the way through to the accumulated depreciation account, and those would be all our assets. We could look at the notes payable account all the way down to the salaries and wages payable account, and those are all our liabilities. We could take the common stock, retained earnings, and dividends and those would be our stockholders' equity. We could take the revenue account of service revenue as our revenues and our salaries and wages expense all the way through depreciation expense to create our income statement. So taking this adjusted trial balance, we could go and create a trial balance that creates the income statement, the statement of retained earnings, and the balance sheet. Note that we would take in red at the bottom the service revenues all the way through depreciation to create the income statement. Once we created the income statement and find out what net income is, we could create the statement of retained earnings. Once we figured out what the ending retained earnings is, the $2,360, we could then create the balance sheet. Notice that all the values that are in red are the balance sheet accounts, and we take the retained earnings balance of $2,360 from the statement of retained earnings. So hopefully you have seen that making adjusting journal entries at the end of every period is very important to ensure that the financial statements are accurately presented.